loan officer training series with the mortgage calculator. Today, we are going to go through a training here for loan officers on qualifying borrowers with a 1099. What we'll do though is wait just a few minutes here so we can go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. We'll give everybody a chance to jump on. Go ahead and drop a comment there in the chat. We put the chat up on the screen, but I see there were some people already commenting, so appreciate the comments and tuning in nice and early. Looks like Owen, Harriet, Oscar, John, Julio, Crisita, Adam, Adrian, Malik. Thank you for tuning in and dropping comments. We will get started here in just a moment. Hope everyone's been having a great week so far. Ready to close some loans, right? Hope everybody's closing loans. All right, Nicole, thank you. Jose, thank you for tuning in and commenting. All right, looks like we are live on all the different platforms, so we can go ahead and get started. What we'll do is we'll take the chat off the screen, and then we'll get into it here. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. What we do on our loan officer training series every Tuesday and Wednesday night at 7 p.m. Eastern is go through some different trainings for loan officers. We are a correspondent lender that specializes in non-QM loans. And today we're going to be talking about one of those non-QM loans. So I'm going to go ahead and turn it over to Jose here. Jose is our sales manager with 27 years of experience as both a loan officer and a realtor. So he is going to do our training here on qualifying borrowers with a 1099. So go ahead and take it away, Jose.
All right. Good evening or good afternoon for our West Coast MLOs, and maybe those of you that may be lucky enough to be in Hawaii or something like that, right? Maybe you're having lunch checking us out. 1099 loans are very interesting. They're self-employed borrowers, but it's almost a type of hybrid self-employment because there are certain requirements that need to be satisfied that would almost make you think that you are dealing with a regular employed borrower who's not a sole proprietor or an independent contractor, which is what 1099 borrowers are, right? But the beauty of this is that if you were in this morning's rate show, I was explaining, you can get up to a 90% profit margin to be considered. So that means that we would only discount 10% of the income as expense, giving the borrower 90%. So it is mainly for a service-based type individual, right? So let's get into it here, and I will share all the details with you. Let's give it a minute while the system queues up the presentation. So one thing to note for the 1099 borrower is that it is a great alternative other than going bank statement for your self-employed borrowers, or other than going profit and loss for your self-employed borrowers, because of the higher profit margin that you're going to be able to obtain. Typically, the default for a bank statement loan is 50%, right? Where then you can get a higher profit margin with the providing by the borrower providing a letter, a third-party verification letter from their tax preparer or their accountant or their CPA that allows you on your typical and on your bank statement loan to go higher than 50%. Whereas on the 1099, the default is usually 90%. All right, so let's jump right into it. So First and foremost, what is a 1099? Now, the one I have there is a 1099-R. It's not the 1099-NEC, which is the one that's actually required, but it is an IRS form that is issued to sole proprietors, independent contractors, partnerships, and LLCs. It is for non employee compensation only, right? So, who qualifies for a 1099 loan? Right. So you're looking at US citizens, permanent resident aliens, non permanent resident alien with US credit. Now, what is a non permanent resident alien? Almost sounds like we're talking about somebody like from outer space or something, right? Well, a non permanent resident alien is an individual living permanently in the United States, earning their income only from their US based work, and who has a work authorization permit. So, a non permanent resident alien is going to usually benefit from all of the same uh, loan types that a permanent resident or U.S. citizen will be able to obtain. Now, I will state that it is not an across the board acceptance. In other words, not every option that we have accepts non permanent resident aliens. So we would have to review the guidelines to make sure that the option that you are choosing or that your borrower is considering accepts non permanent resident aliens if your borrower is a non permanent resident alien. With that being said, I will state that foreign nationals are not allowed or will not qualify under the 1099 program because of the nature of what a foreign national is, right? A foreign national is an individual who is not permanently residing in the United States, right? They permanently reside full time somewhere else. They may come to the U.S. On a visa, work visa, like a business visa. They actually call it investor visas. They may have a business here that they own, but remember, they could be a business owner, but they're not an employee of the business. So they have a right to own the business, file taxes to the business, but not use their US based income to qualify for the loan because they're not allowed to live here permanently. So, due to that, they would not be receiving a 1099 that would be able to be used for the purpose of qualifying for a loan. So, again, foreign nationals, just by the nature of being a foreign national, cannot use 1099 for a loan. Now, entity vesting is allowed on investment properties. The usual, the LLC, the corp, the S corp, or the partnership. However, again, be aware that there may be some of the options out there for 1099s that do not allow entity vesting, but the majority of them do allow entity vesting. You can use this program for primary or investment properties. The important thing to note is that it is for non employee compensation only. Now, with that being said, that does not mean that you cannot combine a 1099 borrower who may also have other income streams. That 1099 borrower may also have W-2 income from a separate from an employer, right? Where he's an employee, but could also have his 1099 income that he's getting as a non-employee, as an independent contractor, for example. Prime example of that would be a real estate agent. That's the most popular use of 1099 that also has a full-time job, right? So that you could have those two income stream, and that real estate agent who has a full-time job could also have a separate business that they could be running, that they could also have bank statements for. Business bank statements now is a real real busy individual, obviously, right? But they could have their business bank statements also for the business, and then they could also add the business bank statement income stream. So we can get pretty creative here on how we can use this, but in this training here, we're specifically talking just about the 1099 components. But I want you to be aware, because it's really important when you are sizing up those deals and doing your income calculations, that you do a thorough um, interview of your borrower to see how many income streams they may have, because there is no limit to what they have if they actually have it. That's the key. So like I was mentioning, this program, perfect for realtors, is one of the types that could benefit from this the most, just because of the nature of the job. Uh, Now, this option does require at least 2 years of self-employment with at least 2 years business existence. But like everything else out there, we may be able to obtain an exception for a licensed borrower who has the experience in the same field when they were an employee, but now transitioned to being self employed. What would be a prime example of that? Let's say an electrician, for example, if they have a license as an electrician, they were working for a company, and now as an employee, right, W-2 employee, and now they transition to 1099, and they've been doing 1099 for at least 1 year. That's one that we would definitely be able to get the exception on. Or someone who, let's say, they were a licensed they're a doctor, right? Doctor needs to have a license, and they were working for a firm, for not self-employed. Now maybe they started their own firm, or they bought somebody else's firm, and now they've been uh, 1099 for a year. Well, I don't think the doctor would be a good example, because they would be self-employed. But you get the idea. Licensed individual working the job, and then they transition to self-employment or independent contractor, where now they're getting the 1099. We would probably be able to get that exception. So don't corner yourself and think that just because they don't have the 2 years that the deal is dead. You just try to see what experience that they had before they were 1099, to see if you could obtain the 2 years that way. So, what are some of the credit and asset requirements? Now, I will put the disclaimer out that we have so many different program options, and we're trying to generalize here. And I don't want you to think that these are the only options. So I try to get as varied as I can by giving you, like, usually the lowest FICO scores and the highest FICO scores, stuff like that. But we have over 5,000 different products and programs that we can pick from. So it becomes a little hard to look through every single one. That's one of the benefits of being at the Mortgage Calculator, is we have so many choices. What I'm trying to do here, more than anything else, is to just show you the framework on how to analyze the situation, put down some of the main points here to give you guidance. And then from there, that'll open the door for you to keep doing your own research when you have your 1099 options, and look through all the different options that we have, through all the different sources that we have for you to obtain the information. Because you got to remember, we have all of these guidelines now are in our knowledge center. So you just click on the guidelines tab, and they will all pop up for you. But letting you know that we can go with credit scores as low as 600 at an 80% loan to value. But mostly you didn't know that. Now, there are going to be trade line requirements, at least 2 trade lines reporting in the past 24 months, or 3 trade lines in the past 12 months. Now, the preferred options are ones where you're going to get the highest loan to value. Best rates are usually going to be 660 and above, same trade line requirements. There is a seasoning on title, usually of 6 months, to use the appraised value for most of these options when you're doing cash out refis. Uh, there is usually not any asset verification when you're doing cash out refis, meaning that most of these options allow you to use the cash out proceeds as reserves. Now, again, that's not 100% of the options allow that, but the majority do allow that. Now, when we're talking about credit events, right? Credit events would be foreclosures, short sales, deed in lieu. That's what we're talking about. Credit events. We're not really talking about like a charge off or anything that's handled separately, but just serious credit events. We're looking at 48 months for the best case option, but for 600 plus FICO score option, which is I think like a C grade, you're looking at only 24 months seasoning. So that's pretty good when you're looking at that 600 option. Again, when we're looking at housing payment, right? Housing history, mortgage payment history. Again, your best options are going to be 0 times 30 for the past 24 months. But again, for our C grade, you can actually have 1 times 120 in the past 12 months. You can actually have gone 4 months delinquent. But again, they're going to limit your loan to value on that option for 70%. And these loan to values that I'm talking about here are for purchases when I'm giving you loan to values, not for cash out refis, which usually have LTV reductions. And then when we're talking about reserves, all of the non-QM programs tend to have some kind of a reserve stipulation. So for our best case options, you're looking at 6 months, but we do have options that ask for no reserves at lower LTVs and lower credit grade. Usually it's like a 70, 75% below like a 70 or 75% LTV. They may have no reserve requirements. That's why you wonder when you're sizing up your deals, what do they mean by A credit, B credit, C credit? Well, that's what they're talking about. So you could have an A credit bar as far as your actual credit score and housing history and all that kind of stuff, but maybe you don't have the necessary reserves. So one solution may be to drop it to a lower credit grade, a B or a C, and possibly qualify your borrower under more relaxed guidelines that are obviously going to result in, like I was saying, lower LTVs and higher interest rates. But it all depends what the needs of your borrower are. So, what type of properties and LTVs are we looking here at this type of program? Well, obviously, your single families. Now, these are different LTV. Here I'm talking about primary residences. If you're talking investment, again, you're going to have LTV drops. But we're looking at best case scenario here. Highest LTVs is non-QM is always 90%. So our single families and our PUDs allow us to go up to 90%. What is a PUD, right? You may ask, right? Weird word. It's a planned urban development. That would be, for example, a single family home, whether it's detached or attached, could be a townhouse, in a community that has a homeowners association. So a deed restricted community with a homeowners association would be considered a PUD, and that could be single family detached or single family attached, which would commonly known as a townhouse. Warrantable condos up to 90% LTV, but again, not for every option out there, but most of them will allow warrantable condos to go up to 90%. Now, what is a warrantable condo, you may ask? A warrantable condo is a condo that conforms to agency loan, to Fannie Mae, but usually Fannie Mae guidelines. Fannie Mae guidelines, if you recall your condo questionnaires when you've had your condo loans, They're going to ask for things like percentage of owners that are delinquent on the payment of the monthly association fee, uh, percentage of properties that are lived in by primary for a primary residence and second homes versus those that are rented, because that's another big point. If you have too many renters, you're not going to qualify. If the association is collecting at least 10% of the association total budget into a separate reserve account, those are some of the typical warrantable condo items that are going to disqualify a condo when you don't meet the guideline. Like if you have less than 10% reserve, you're not going to cut it. I think it's 15% delinquencies in the collection of the monthly assessment. You're not going to cut it. I don't recall the percentage of renters, but you get the idea. If you don't meet any of those guidelines in the condo, when you receive the condo questionnaire, then you don't have a warrantable condo, and you're going to get a reduction. Or you'd have to, you're usually going to have to go limited review condo, and that's going to result in an LTV reduction. It's 75% for primary and 70% for investment properties when you have a limited review condo. Now, 2-unit properties are usually going to be possible up to 90%. Not in every option, but most of them. 3 to 4 units, there is a reduction up to 85%. Modular homes are acceptable. Modular homes are going to look just like a regular home. They're just part of it is prefabricated at a factory, then they get built at the site. That is not, I repeat, a modular home is not a manufactured home. Manufactured home is basically like a trailer. It is trailered. It is taken, transported to the home site in 2 pieces, put together, and once it's put together, it's affixed to the land. It has the land associated with it, and then it transitions from being a trailer with a vehicle title to a single family home. But it's not a modular home. Condotels. Now we all know condotels. How they, that's a condominium that allows short-term rentals, but it's a little bit more of a hotel feature than just allowing short-term rentals. It has a front desk to receive the short-term rental guests, and usually they have some type of a restriction on the maximum amount of time that the owner can occupy the property in any given year. So again, they restrict their LTV to 75. Then we have non-warrantable condos. For those of you that are looking for something a little bit better than doing a limited review, we do have options that'll do non-warrantable condos up to 85% as primary. Again, this is as a primary residence, 1099. And I found, nice interesting nugget here. Rural properties permitted up to 20 acres, up to an 80% LTV. And this actually is for 1099 as well as most of the other income streams. We do have options that allow rural properties, those designated rural. Now, there may be certain requirements when it is designated rural on the appraisal that you have to overcome. It's usually going to depend on the distance that the comparable sales are from the subject property, and the distance usually to like the nearest convenience and stuff like that. Like if you're 25 miles away from the nearest convenience store or shopping or anything where you would be able to buy something, they're not going to take it. And if your comps are 7, 8, 9 miles away from each other, they're usually not going to take it. So it says they're permitted, but you got to look at the guidelines. So, what are some of the requirements to be able to use this type of income? Well, they're usually going to require some type of business narrative. So, you would have to refer to the guidelines of the specific option that you're using because they may have their own business narrative form that you need to use. So, keep in mind, though, definitely a business narrative is going to require and here's a real interesting point. So you got to make sure that you look deep into the guidelines of whatever option for that 1099 you're using, because some may require the borrower to be with the same 1099 provider for the last 2 years. This is why I was saying that the 1099 can be considered a little bit of a hybrid product, right? Because what happens a lot of times now for realtors, it's always 1099, but we get cases where an employer says, I'm not going to have any more employees anymore. I'm switching all you guys to independent contractors. I'm sorry, I can't afford to keep you anymore as a W-2. They can't afford the payroll taxes, so forth, whatever may be the reason. So now that person that was working for company ABC as an employee is now an independent contractor. So that happens a lot of times. But just keep in mind that there may be, I'm not saying there's a requirement in every option, but there may be a requirement for the borrower to be with the same 1099 provider for the last 2 years. You're usually going to be required to provide at least one complete year 1099. So the last one would be from 2022. And a lot of times they do require, again, talking about the hybrid function, they do require that 1099 to be validated with a wage and income transcript from the IRS. So look deep into the guideline and make sure that whatever conduit you're using doesn't require that, because if it does, you may have to switch your borrower over from 1099 to bank statement. But again, remember, we love the 1099 because of the 90% profit margin, quote unquote, that we can use. Now, you may also require some type of confirmation from the employer that the borrower does not have any job-related expenses. Because remember, we're not using their tax return for anything. That's usually what that would be. It would be in their Schedule C, which is where usually 1099 people put their income. They don't have a corporation or anything like that. So again, keep in mind, look deep into your guidelines and make sure that you don't have that pitfall. And I've mentioned it multiple times about the 10% expense factor or 90% profit margin. Now, there are some LTV limitations depending on the DTI, and this could be a little tricky for you all when you're sizing up the deal. This could get you in trouble, but the max 50% DTI is usually going to be below 85% LTV, because usually above 85% LTV, you're limiting your DTI to 45%. And a lot of times we don't think about that. We're immediately thinking non-QM that allows us to go up to 50%. You're pre-approving your borrower. You run your quote. You get your rates. File goes to underwriting, and then you get hit with a counter offer LTV reduction to 85%, and you can't figure it out why. It's because your DTI was at 49.99. So again, look at your guidelines to make sure you don't run into that obstacle. And another important point is that most of the options do require some type of income verification from bank statements, and usually they're going to want the last 2 months bank statements, not necessarily for assets, because you're used to providing the last 2 months bank statements for assets on a purchase, but to just confirm that they're actually receiving money, because we're not going to usually be asked for pay stubs, right? So in lieu of the pay stub, they may ask for the bank statement. So take a look at those bank statements that they have and make sure that it looks good. So what are some other points of interest and seasoning requirements? Because I like to put some little extra things where it's hard to categorize them into the other sections. But note again, on your cash outs, refis, you can use as little as 6 months seasoning for most of the options that we have to use the appraised value. Note that on some of our options, not everyone, but on some of our options, gift funds are allowed with up to 100% with a minimum of 5% of the borrower's own funds. So borrower comes in with 5% of their own money. You can use the rest of the money for the transaction. Could be gift funds. Private verifications of employments are accepted with a reduction in the LTV. Now, this is good if you need to confirm the housing history for whatever reason for your borrower, and they're paying cash to an individual owner. That's what we mean by a private VOR. Well, in some of these cases, it is acceptable, but there will be an LTV reduction. And here's another interesting point here, last but not least, is minimum square footage, right? So those of you that are out there trying to corner the tiny house financing market, well, you can do single family residences as small as 600 square feet, even though I think that would be a pretty big tiny house, but 600 square feet. You can do condos 500 square feet. And here's the real important one to note, though, really the one that is probably going to affect us more often than not. On a 2 to 4 unit, the minimum size for the units are 400 square feet. And in all cases, the properties need to have a full kitchen. They cannot have a kitchenette, right? So you got to have like a range or a cooktop and an oven. You got to have a sink, and you got to have a refrigerator. Dishwasher, that's an option, and trash compactor, those things are option. Microwave is an option, but you got to have a sink, you got to have a fridge, and you got to have the ability to cook, right? You got to have a range, or if it doesn't have a one-piece range, a cooktop, with burners and an oven. So real important because a lot of times, we get properties like studios where they meet the 500 square foot requirement. It's a big studio, but it has a kitchenette, right? It has a little tiny like a bar sink, and then it has maybe a 2 burner, no oven, a little tiny refrigerator. That's not gonna fly. It has to be full kitchen and its own bathroom. Can't have the bathroom down the hall on a 2 to 4 unit or on a condo. It has to be bathroom in the units.
All right. I don't see any questions. One person had trouble with the video.
Yeah, I don't see any questions in here either.
So, guess you want to wrap it up?
Yeah, I guess we can wrap it up. We do have this training tomorrow at 7 p.m. Eastern as well, so definitely tune in. Tuesdays and Wednesdays, 7 p.m. Eastern. We do these loan officer trainings. You can always visit us at themortgagecalculator.com if you want to get in touch or need more info. But thank you, Jose. That was great. Remember, everybody, 1099s, great option, great option. Maybe instead of a bank statement. Always keep that in mind when you're looking at those type of borrowers. But thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all tomorrow, 7 p.m. Eastern time, on the next episode of the Loan Officer Training Series with the Mortgage Calculator. Everyone, take care.
Thanks, everybody.
All right. Have a good night.